You are giving yourself a pay cut. You're literally cutting your pay by doing this. Where you're getting the most growth in the S&P is from the growth of the investment. Is the principal growing? It's not the dividends.
You're picking the stocks that are going to pay a lot of income to you, and you live off that.
Yep, that's it. Guess what? Surprise! That's actually not the best way to do things.
Companies go bankrupt too. That means the dividend completely disappears, as does your investment. So if you're picking something that, yes, this is a risky investment, but I get some great income, how would you feel if your dividend got cut and then your money disappeared? This just blows my mind, how someone is like, I just need to keep selling the things that don't work, buying something else that will work. There's no strategy here. So will you keep running out of money if you keep selling shares? Maybe, if you don't have a full design here. That's why you need to... An old portfolio design that has been knocking around for decades is the dividends and interest model. It's outdated, it's inaccurate, and it doesn't work anymore. And we're here to rip it apart. Do you agree?
Oh, you didn't see the eye look that I gave the camera.
So sit back, relax, and if you are a dividend and interest investor, buckle up. Welcome back to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host is Heather Townsend, and we are talking about dividends and interest investing today, specifically the model that you design to fund your lifestyle through the dividends and interest. We hate it. So before we talk about it in too much interest, we don't hate it, it's fine. So without further ado, let's dive in. All right, Heather, the game has changed.
The game has changed.
Take us through it.
Okay, I actually wanted to start off. This is actually how I was raised.
Okay.
So we haven't gone into a lot of detail of this, I don't think in our podcast, but everyone has their own money stories. There's other terms, money scripts.
Mm-hmm.
This is one of my childhood stories. Do not touch the principal of your portfolio. Like You only are supposed to live off the income, the dividends, or the interest. That is it. You never touch the principal. So if you have $1 million portfolio and it spits off 30,000 of dividends, you only take the 30,000 dividends, nothing else. That is the rule. That was how I was raised.
Mm-hmm.
And so, of course, when I got into my profession, financial planning, was I blown away to find out that that money story and that money script was very wrong and not the way to do it. Like, I had to really study this, read books on it, because it was so ingrained in me from a childhood.
Yeah.
Literally. Don't touch the principal. Don't touch the principal. Don't.
I don't think it's just your family either.
Really?
I think I have heard that from people who are older and came up through, either the Depression or through recessions. It was dividends and interest. That's your paycheck. That's it.
Yeah. You don't touch the underlying investments. Mm-hmm. So you own GE. You only live off the dividends of GE. You don't ever sell the GE stock. Now we've gotten very specific.
Yeah. You're picking the stocks that are going to pay a lot of income to you, and you live off that.
Yep. That's it. All right. Guess what? Surprise! That's actually not the best way to do things.
Okay.
Why are you giving me that smirk? You know this too.
I'm trying not to jump off the deep end with you.
I know. But for a long time, this was considered smart investing. All right. Why is that, and how has the world changed? Back in the 80s and 90s, I was born in the 80s, so this was exactly when this was being fed into my ears. Let's talk about how bonds and interest, like bonds and dividends were compared to today. Okay. So back then, bonds were producing somewhere between 6 and 10%. That's how much interest they were giving off.
Per year.
Yeah. That's not the environment today. I mean, if for our listeners that have been listening to us, they know that we're saying bonds are just now starting to get sexy again.
Sure. You keep calling them sexy.
I mean, they're not a very exciting thing, so I guess I have to put some fun word to them. Mm-hmm. Okay. But that is a huge difference. So today is 3 to 5% is the average on a bond. So back then, 6 to 10%, today 3 to 5. That's half.
Yeah.
Half. Okay. Dividends, that part was interesting. This part is interesting to me. So then the average dividends off of a stock or portfolio was 4 to 6%. And today it's 1 to 2.
That's a huge difference.
That's actually more like somewhere between 25 to 33% of what it used to be. That is a big difference. So the S&P 500 of the last 20 years, okay? Your total annual return, so what if you've been invested in the S&P 500, your total return has been somewhere between 9.5 to 10%. If you were just in the S&P 500, top 500 stocks in the US, okay? Guess what the dividend yield is over the last 20 years?
Not that.
No. 1.8 to 2.2%. It's small of the return.
Yeah.
It's small. So where you're getting the most growth in the S&P is from the growth of the investment. Is the principal growing? It's not the dividends.
So if you're looking at having the S&P 500, you're seeing it grow, but you're not able to live off much if you're trying to do this dividend and invest interest model.
No, because most of it, 7 to 8% of the growth, if the total annual return of the S&P is 9.5 to 10%, dividends is only, let's call it 2, and 10 is S&P. 8 of that is from price growth, the stock price growing.
So let's turn that into numbers for people.
Okay.
If you had $1 million,
Yeah.
it grew 10%, you're now at $1.1 million. If you then said, well, I need to live off some of that, if you decided to do dividends and interest approach,
Let's say it's 2%.
you're living off 20 grand off $1 million portfolio, which is not great.
It's less than our little 4% rule.
Yeah.
Like, so the point is, you love our headlines. And so I created a headline for you, Dave.
Go ahead.
You are giving yourself a pay cut. You're literally cutting your pay by doing this.
Love it.
Did you like my headline? You're giving yourself a pay cut? Okay. So the typical method, and is even a conservative method, I would say, is the 4% rule. If you're just living off the dividends, what did I say, 1.8 to 2.2% is on the S&P, and the 4% rule is double that.
So for people who are not aware of the 4% rule, it's kind of a standard in the investing world of what can I pull from my portfolio each year and not run out of money if I'm going through a 30-year period. So we're saying 4%, it's fine. Actually, the research has been revised to be 4.5 to 5%, depending on the market. And now people in the dividends and interest world are living off 2.
So you're either on $1 million portfolio, getting to spend $20,000 or $40,000.
Yeah.
So you're cutting yourself in half. So now let's talk about millions of dollars. Okay, let's say you have $4 million. That's either $160,000 a year or $80,000 a year. That's a lot of travel that you're missing out on.
It is.
Right? Like, that's a lot of experiences, a lot of fun. Like, there's a big difference. Okay. This I want to talk about. You're going to go into the details.
All right.
This is even more important. So we already know price, like pay cut. Here's what's even more fascinating that I've seen. It doesn't lead to good investment behavior.
It's true. I've found that when people are talking about the dividend and interest model to investing, they're typically not looking at, let me buy an ETF. Let me buy the S&P 500. Let me go and buy, an international. They're picking stocks. So
based on what?
They're picking it based on the dividend.
How much are you going? Because I don't want that pay cut. I don't want that 1.8 to 2.2%. I want 10.
Yeah. So it's wild that people are picking stocks based on the dividend alone. Not even the company, not even its approach. It's how much is this going to earn me per year? And take it to the next level. It could be, well, I'm going to buy what we call an MLP, a limited partnership, because of the income it's going to generate, ignoring everything else about it.
The risk, the liquidity.
And so you're getting aggressive investments, sometimes speculative investments, just based on what income it's going to pay out. And the risk that you're taking to get that is wild. Like, it could be off the charts.
I'm going to give it an easier example too. Bonds, right? Again, not the topic that most people are excited about. But bonds is a loan, right? And I think people understand that it's a loan, right? You hold it to this point, you get paid this interest rate percent, right? And it's just like in the lending world on who someone's lending to for a house. If you have a ton of income and you have a ton of assets, your interest rate is going to be lower versus you're going to pay a lot more interest to someone who's a riskier person to loan. It's the same thing in the bond world. Where do you think you get paid a higher interest rate? What's the term, like junk bonds, or aren't they like normally the higher interest rate is the more riskier the bond is, and the more stable the bond is, like not as sexy of an interest rate. So what are you doing now? If you want more interest.
Yeah, I'm looking for those riskier bonds. And I want this. So when people are designing this, this dividends and interest model, that's their pure focus. If you take a step back and look at what their portfolio actually looks like, it's terrible. Like it's not organized. B, like we said, the risk is off the chart. It's scattered everywhere. Like it has no design to it. And people are then saying, well, just look at the income I'm getting off of that. Like it's great. Well, what happens if you go through a recession? Companies cut dividends all the time.
It's true.
Companies go bankrupt too. That means the dividend completely disappears, as does your investment. So if you're picking something that, yes, this is a risky investment, but I get some great income, how would you feel if your dividend got cut and then your money disappeared? That's what happens in private investments. I have one client going through that when they invested in a technology company, and it was a private investment recommended by another advisor who they moved from. It's now in liquidation.
Interesting.
So they're getting pennies on the dollar just fed to them every now and again into their brokerage account that is not what their original investment was.
This would go on a tangent, but why would an advisor recommend that?
The commission, I'm sure, will.
There we go. Sorry, I just don't think that way, right? Like, okay. Because when someone explained it to me this way, it made so much sense. Because we are business owners, right? And, when you're trying to grow a business, do you think you're going to grow it as much as if you keep taking all the money out of the business? What are you supposed to do with those profits?
Reinvest, baby.
Reinvest it, right? Reinvest it in marketing, reinvest it in your brand, reinvest in how you're going to serve your clients or your product you're selling, whatever, right? So actually, some of the best companies that are growing and are going to have that growth and that higher chance of success are going to be reinvesting their profits. They're not going to be distributing them out. Think of the huge growth companies that are coming up, especially even the new technology companies. They're constantly investing in research and development, how to make their product better, whatever.
Yeah.
They're not paying out to the shareholders except if they're really mature companies. And if they're really mature and kind of stable, there's not as much growth left.
Yeah.
And it makes perfect sense. So it's actually these really big dividend companies or companies that are paying large dividends are actually really mature. And I could even argue because they're not investing in research and development, again, yes, I'm taking it farther, are probably more at risk and not being a very good investment.
It's interesting, I think, when people are looking at this portfolio that they can build. And it's, okay, can I get my money back quicker through these dividends? And I think for people who are just starting to look at that, that's what a dividend is. This is a payback of the profits of the company that you're buying into. And so if you're looking at, okay, I can get my money back and my investments back quicker if I get a higher dividend. And I can kind of get that back in my pocket and I'm taking less risk that way. I can get my money back. Well, sure, you're getting your money back, but your portfolio is not necessarily growing. Like you just said, these are companies that are not ideal. Some of them may be, but some of them are just paying out the profits because they're not looking to grow. That's not their path right now. Like they've made it in the world of investing. They're big enough where they can just
coast.
Go on that. That's the word.
Yes. And inflation, like you're not being, then if your portfolio is not growing, then inflation happens. And then what happens? Because your investments aren't growing, you have less of the pie, right? Your million didn't grow, inflation. So you're taking your 2%, best example for our listeners right now, okay? You got your $1 million, you're taking your 2% from your dividends, your 20,000, and now inflation happened in America in the last 4 or 5 years. Your dividends didn't move because your portfolio didn't really move that $1 million. And so what are you doing? How are you paying for your more expensive coffee and
20,000 doesn't go very far now, does it?
No. And so now what are you going to do? Back to that bad investment behavior. I'm going to go pick some investments that are going to give me that higher return, and I'm going to take on more risk. And oh boy. All right. I think, okay. Do you know one last thing on this? Berkshire Hathaway, one of my favorite people, Warren Buffett.
Yeah.
Berkshire Hathaway, company founded by Warren Buffett, doesn't pay a dividend. They paid it once, and he thinks it was one of the biggest mistakes ever. He doesn't believe in them. Buffett does not believe in dividends.
And you can definitely see that the way he runs his company, buying a lot of stuff through that reinvesting of the profits.
Okay. I think we've made our point there. All right.
We have taxes.
Oh, yeah, we have to touch on it. But there's the tax alpha, aka the way that taxes are managed in a portfolio make your returns higher or lower. It is important. More money you get to keep. The thing with dividends and interest is you don't control the payout.
True.
You have no control. It's when is the payout going to happen? When are they going to give it? You have no control.
I'd say the one nice thing about this dividends and interest approach is that a lot of companies that are paying out their dividends, it's going to be classified as a qualified dividend. Like, we are getting nerdy in the tax code here.
Yeah.
Of it's a lower tax rate than an ordinary dividend.
Yeah. They're long-term capital gains, basically, is how they're taxed. Yeah.
So it's nice in that. But again, you don't control that.
But that's not true on interest. Interest is the worst, actually. It's ordinary income rates. And I could argue the same thing on how we take money from a portfolio, whether you take it as qualified dividends, long-term capital gain rates. If I sell a stock, as long as I hold it for a year, what happens?
Long-term capital gains rates.
But what's the difference? I'm controlling when we press that sell button. I have my control. Dun, dun, dun.
Oh, when the tunes come out, I'm excited.
Well, I mean, okay, there's things that have happened in my client's life. Let's say our retirees, I know you've had this, where money falls in their lap from maybe an inheritance, something happens with the company they used to work for, whatever, and they now have more money in their pocket than they needed. So we don't need to pull from the portfolio this year as much.
Yeah.
Okay, well, if you're in the dividend income approach,
oh, well, it's coming to you anyway.
Yeah, there you go. My point exactly. So we get to control in this method. And I guess we haven't really said what our method is, if someone is listening new, is, and I guess that might be in my summary, but we aren't doing the income dividend method. We are selling a portion of the portfolio, and we control taxes, we control timing. There is control.
When it comes down to, do you take part in this dividends and interest model if you wanted to? I don't see it as an investment design decision. I view it as a tax decision, because all of this is based on you're going to get taxed on this income. If you're in a low tax rate, this may be great. It's not the best investment design, but tax-wise, you're fine. If you're in a high tax rate, now you have a poorly designed portfolio and you're paying taxes out the wazoo because you did this. So it's a double whammy.
I have to say, because we are a little nerdy and then I'll leave it, but if you're investing in muni bonds, I want to just give the disclaimer that that's not taxed at ordinary income rates. Those are the state and local bonds.
Thanks, nerd.
Okay.
You want to wrap it up?
I do want to wrap it up. Okay, so here's my summary on this. If you are doing this, you are cutting your spending in half. You're literally giving yourself a pay cut. You could probably be taking more from your portfolio and living a better life, and I want that for you. Dave and I both want that for you. You're limiting growth in your portfolio, most likely because you're probably chasing the wrong investments for this dividend yield based on inflation, and it becomes a vicious circle. We've went through that. And it's not tax efficient, and you lose tax control. So no go. This is a no-go, okay? There is a better way, and that is invest in an index fund, ETFs preferably. They're tax efficient. Live off a sustainable withdrawal percentage from your portfolio. So that's where we were talking, the 4%, it could be 6%, it could be 5%. All of our clients have a different withdrawal rate. It completely depends on your situation. But for example, you have $1 million. Are you taking 4%? So 40,000, 50,000, 60,000. And as that portfolio grows, your 4, your 5, your 6, it's growing with you. It's amazing. Okay. And then sell what you need. Have a withdrawal strategy. And the best resource, if we have not convinced you, I'm going to give a plug.
JD.
Yes. You need to read the book Income on Demand by Jonathan D. Bird. He used an amazing book editor, and it's a fantastic book. It just proves all of this with all his data and all his research. So if we have not convinced you, go read that book, Income on Demand by Jonathan Bird. It's a great book, but there's a better way. Okay.
Yeah, if we haven't gone nerdy enough for you, dive into Jonathan's book.
Yeah. But I'm really glad we talked about this with our listeners, because for me, how I was raised, I'm sure there's other people out here who have heard the same.
Mm-hmm. Especially if you've been raised in the 80s.
Yeah.
That was the way.
That was the way. Things change.
All right, before we move on, you've obviously learned about dividend and investing. Your knowledge has greatly improved, so we would like something in return. If it's not going to cost you anything, a like, a comment, subscribe, a follow, any one of those. We want to spread this message as far and as wide as we can. We're trying to get our YouTube up. If you're watching on YouTube, hit that subscribe button, hit that follow button. If you want me to get really nerdy, hit the notification bell and make sure you get a notification whenever we release a new episode. All right, we're going into the question segment of the podcast. It's called What Would You Do? Quick and dirty question for you. What happens if the stock market drops 30% and I have to sell everything?
If you're doing this method, that's a good question. It's why we have the buckets. If you haven't listened to our podcast before, Dave and I have a love for the buckets.
Come closer. Let me tell you about buckets.
Buckets. I do love the buckets.
Every other episode, I believe it is.
Talk about the buckets, but this is why we have 1 to 2 years of cash, of living expenses. That's in a money market, earning something, and then we have 3 to 7 years in fixed income bonds, so that if the stock market drops, we are going into these buckets so that your withdrawal percentage doesn't have to change. Question 2: won't I run out of money if I keep selling shares?
This just blows my mind. How someone is like, I just need to keep selling the things that don't work, buying something else that will work. There's no strategy here. So will you keep running out of money if you keep selling shares? Maybe, if you don't have a full design here. That's why you need to go and have a withdrawal rate on your portfolio that's sustainable with a good portfolio design. Get away from this dividend and interest model, because there's a lot of words I'll use. It's not good for you.
I mean, I'd say if you have 30 years left to live and you take 10% of your portfolio, you might run out of money, right? I just know sustainable withdrawal rates, right? And if you want to leave, I don't know, half your portfolio as an inheritance, okay, and you're taking 10% withdrawal strategy for 30 years, yeah, that's probably not, going to happen.
Yeah.
But this is why you have a financial plan.
All right, this is a good one, because I get this question when people come to me with this model. Number 3, aren't dividends safer and more reliable?
Yeah, I had to do research as examples on this, because I was like, I can say no, but I think examples really prove. Okay, so GE really gets talked about a lot.
It does.
I think because, and I want to go back to our listeners, it's not that it's just a great example. The reason I keep bringing up GE is I was raised with GE as one of the top, and it stayed in the top in the S&P, like one of the top performing companies, I think, for multiple decades. So that's why it's so fascinating. Okay, so GE in 2017 cut its dividend in half.
It's wild.
So, okay, you're feeling like, you have half your portfolio in GE, that's your dividend that you're living off of, and now it just cut in half. What are you doing?
That's not abnormal for a retiree portfolio back in the day.
I know. It's crazy. Okay, there's more. Citigroup, beginning in 2008, cut its dividend 40%, and then another 50% later in 2008. Ouch.
Mm-hmm.
This is what can happen.
Yeah.
That's why, I go back, diversified portfolio in index funds, you're owning multiple companies, and you're not worrying about this, and you got buckets.
Yeah.
I think it's psychological. It's easy for people to understand, oh, it paid me. It's like a paycheck. It paid me, so I know that that's safe, and I can take it. It is simple. I will give you. It's simpler than our method.
Sure.
Totally. But that doesn't make it better.
Because it's not.
I know. Sometimes, in this case, I will say simple is not better. Okay. All right.
All right, we're going into the final section of our podcast. It's called Highlights. This is where you get to learn about us personally or professionally. I go through cycles of reading lots of books, and then I read none.
Yeah, I haven't heard you talk about reading a book. I always hear you talk about Netflix.
That's my cycle. Watch a lot of shows, read a lot of books.
Interesting. I just learned something new about you. On what episode are we on?
66.
Okay.
I like to keep it fresh. Okay. Keep you guessing. I am late to the game on this book series, but there's a movie come out recently called The Housemaid. And I thought there was one book in the series. There's apparently 3.
Oh.
And I didn't watch the movie yet because I wanted to read the book first. It was not what I was expecting.
What were you expecting? And give me
I have no idea what I was expecting. That's the cool part.
Oh, okay.
I mean, I was at a wrestling meet for my 13-year-old, and there was a middle school girl reading the Housemaid book that I just got from the library and hadn't opened yet. And I was like, I don't know if I want to read this now. Then I got home and read the book, devoured it in a weekend.
So it's great.
Phenomenal book. But it's an easy read. That's the nice part.
Is it a romance? Is it a thriller? It's
a thriller. Like it's a slow burn thriller.
Like murder thriller?
I'm not telling you.
Oh, okay.
But there's 3 series. There's 3 books in the series. I am on the second one. Almost done with that. I have the third one with me while we record. I'll probably start digging into that too. It's really good. So I love it when I get those books that just like you get wrapped up in, and then you just run to the library to get the next one.
I actually think reading a book sometimes is better than binge watching. Like there's something more relaxing about being...
That's very calming.
Yeah.
I like it. Even if it's a gripping book.
I haven't read a good fiction book in so long because I'm so enamored in finance and business books, but it's a good reminder. Okay, maybe I'll
You should try it. It's easy. You'll get through it in a weekend. It's easy.
Okay. I don't normally like death and murders or anything, and I don't watch those kind of thrillers.
Read 2/3 of the book.
Okay, that gave it away.
All right, what about you?
So I just got done wrapping up my girl's 5th birthday weekend.
They get a weekend.
It was a whole thing. Dave, my girls picked a very weird birthday theme.
Okay.
They picked it after their favorite animals. It was called the Puppy and Moose Adventure. That is the birthday party I put on. A Puppy and Moose Adventure.
They don't sell decorations like that in a packet at Party City, do they?
No, and Party City I think is going bankrupt, but it took a lot of planning and a lot of Amazoning, and there's actually more moose stuff than I thought, but I pulled it off.
Nice.
And then one parent came and goes, and I thought I did great, and then goes, oh, Heather, I thought you were going to have all these puppies to pet. All right.
Did you have moose to pet then?
That's what I said. I was like, I have twins. You can't do one thing and then I can't, like, how would you make an equivalent of puppies to a moose? You can't. Yeah, you're still stuck. I know.
Well, I was going to say you could buy some moose headbands and put it on some puppies. No?
Anyways, I don't know if this is usual, but, I thought, I was thinking princess theme or no, puppy and moose. Like, what am I in for with these girls?
Good luck.
Thanks. Okay. But it was a great birthday.
Good. All right. Thank you for listening to this episode of Playbook of the Wealthy. If you want to listen to us on a more ongoing basis, we are on every podcast platform you can find us. If you want to watch us, because who doesn't, we are beautiful. We are on YouTube, Spotify, and Instagram. If you want to look at our website, because again, we're very pretty. The photographer did an amazing job. We are at playbookotw.com. You can also send us your questions to get featured on the podcast. Our email is hello@playbookotw.com, and we'll see you next time.
Toodles!
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.